Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm starting the problem number 16. Already 15 problems I have uploaded in the previous videos. So in those problems specifically it was asking you to calculate so and so ratios. But from here onwards they will not specify. In the problem simply it will give you test the liquidity, test the profitability, test the solvency like that. That means it will not specify which ratios you have to calculate. You have to decide which are the ratios which will be applicable for testing the liquidity, which ratios will indicate the long-term solvency, which ratios indicate profitability. You must know as a student. So from here onwards, the problems will just ask you find out the liquidity position of the company, find out the profitability position of the company, like that. So until and unless you are fully acquainted with all the problems, with all the formulas and all the theoretical aspect, you cannot do this type of problems. So these type of problems require the complete knowledge of ratio analysis theory as well as problems. So my suggestion, if you want the complete command, watch the videos from beginning. Don't ignore the beginning videos. There I have explained you each and everything about basics of the formulas. So if you have not watched the earlier videos, I suggest you to go to the playlist of my channel, select the subject financial statement analysis, select the topic ratio analysis. Watch the first 3 videos. I have explained you in detail regarding the theory of ratio analysis and all the formulas which are applicable for testing the liquidity, for testing the leverage, for testing the activity and profitability. All these things I have explained. After watching that, you will be in a position to solve this type of problems. Now I am going to start the next problem number 16. So before starting 16th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready before start watching this problem. 16th one. Following is the balance sheet of Sagar Limited for the year ending 31st March 2017. Calculate ratios for testing liquidity and testing solvency. Not specified what ratios you have to apply. Simply given you have to apply the ratios for testing liquidity and you have to apply the ratios for testing solvency. Now what are the ratios which indicates the liquidity of the business? Liquidity ratios. 4 liquidity ratios are there, but out of 4, 3 are important because last ratio, the data will not be given. The current ratio, the quick ratio and the absolute liquid ratio. These 3 ratios will indicate the liquidity of the business. Secondly, for solvency, solvency means long-term solvency of the business, whether the business can be able to go for long or not, and how much is the proportion of debt and how much is the proportion of equity. Those type of problems, therefore those type of ratios are called solvency ratios. The solvency ratios are debt equity ratio, proprietary ratio, capital gearing ratio, fixed assets ratio, interest coverage ratio, dividend coverage ratio. So these 6 ratios will tell about the solvency of the business. That point you have to remember while doing this type of problem, right? Now what information is given in the problem? Balance sheet is given of Sagar Limited. Share capital 7,50,000, note number 1. And note number 2, reserves and surplus 2,50,000. Non-current liabilities 12% debentures 2,50,000. Then current liabilities, payables 1,02,000, provision for taxation, bank overdraft. So 3 current liabilities are there: payables, provision for tax, bank overdraft. And long-term debt, debenture is there, 2,50,000. And assets, fixed assets, tangible assets are given 7 lakh, intangible asset 2,50,000. So both are fixed assets only, tangible and intangible. Then current assets are short-term investments, inventories, receivables, cash and cash equivalent. This is the complete balance sheet given. Now notes forming part of financial statements. Note number 1, share capital. The share capital consists of equity share capital 5 lakh and 9% preference share capital 2,50,000. That means both shares we have, equity and preference. 7,50,000 is the total share capital. Reserves and surplus, second note. Then general reserve 50,000 and profit and loss account balance 2 lakh. So total 2,50,000 are there in reserves and surplus. So we are given the complete balance sheet. From this balance sheet, we are required to calculate the ratios for testing liquidity and for testing solvency. So first of all, I will apply the formulas for testing liquidity. Ratios for testing liquidity. Current ratio. The formula is current assets by current liabilities. As usual, almost every problem we have applied this ratio. The current assets, specifically given in the problem, current assets are short-term investment, inventories, receivable and cash equivalent. Take all the values, will get 5 lakh rupees current asset. Then current liabilities are given 3, that is payables, provision for taxation and bank overdraft. These 3 are current liability, take the total 2 lakh. Now we got current assets, we got current liability. So current assets 5 lakh, current liability 2 lakh. So 5 lakh by 2 lakh, 2.5 is to 1. 2.5 is to 1. That means current assets are 2.5 times more than current liabilities. The standard current ratio is 2:1. If the current ratio is 2:1 or slightly more than 2:1, that means the liquidity position is good. So standard ratio, ideal ratio says the current assets should be at least the double of current liabilities, at least, minimum. So here it is more than double. So we can say the liquidity position is good from current ratio point of view. From liquid ratio, from quick ratio. Quick ratio formula, quick asset by current liabilities. Now quick assets are current assets minus inventory minus prepaid expenses. But we don't have prepaid expenses in current assets. Leave it. So current asset minus inventory. So current asset minus stock minus prepaid. So inventory is stock, 3 lakh. So 5 lakh minus 3 lakh, 2 lakh rupees are the quick assets. And current liability already you have calculated 2 lakh. Quick ratio, quick asset by current liability, 2 lakh by 2 lakh, 1:1. That means the ideal ratio, the standard quick ratio is 1:1. That means if the quick ratio is 1:1 or more, it will be better. It should not be less than 1. If it is less than 1, then the liquidity position of the business is not good. But here it is 1. So we can say the liquidity position is satisfactory. It is ideal ratio. The next, absolute liquid ratio. Absolute liquid ratio formula is absolute liquid assets by current liabilities. Now absolute liquid asset consists of cash in hand, cash at bank and short-term investment or marketable securities. Sometimes it will call marketable securities, sometimes it will call short-term investment, means same. So you have to include cash in hand, cash at bank and short-term investment. And cash in hand, cash at bank are called cash and cash equivalent. Cash and cash in. So simply absolute liquid assets means short-term investments plus cash and cash equivalent. So here 10,000 rupees plus 1 lakh. So 1 lakh 10,000 rupees is the absolute liquid assets. And current liabilities are 2 lakh. So 1 lakh 10,000 by 2 lakh, 0.55:1. That's all. So 3 ratios I have calculated: current ratio, quick ratio, absolute liquid ratio. The standard absolute liquid ratio says 0.5. That means the absolute liquid assets should be at least half of the current liability. If you have 1 lakh rupees current liability, at least 50,000 you should have absolute liquid assets. But here we are having 0.55. That means it's over standard. We require 0.5. Here we are having 0.55. So by applying this current ratio, quick ratio, absolute liquid ratio, we can give the conclusion that the liquidity position is good because the current ratio, quick ratio and absolute liquid ratio are above the standard norm. Above the standard norms. This is the conclusion. So this type of problems, not only you have to calculate the ratios, but also you have to give the interpretation. After completing all the ratios, you have to give the interpretation. What interpretation? Whatever I am saying now. The liquidity position is satisfactory because the current ratio is above standard, quick ratio is above standard, absolute liquid ratio is above standard. The company has good liquidity position. The company is in a position to pay the current liabilities on time. Now, ratios for testing solvency. Solvency means long-term solvency. Whether the business can be able to go for a long period of time or not. This will depend on the proportion of debt and equity. How much is the owner's fund and how much is the debt fund? If a business is having more debt fund, that means the business is having more risky. जितना debt ज़्यादा रहेगा उतना business में risk ज़्यादा होगा. So a business must have the debt. If the business does not have the debt, that means the business is conservative. The profitability will be very low. That means debt is necessary, but we should not have excessive debt. If a business is having more debt than owner's fund, the business is called a risky business. The business, there is a lot of risk that the business may not go for a long period of time. So much of risk. If a business does not have any debt at all, that is also not good because the profitability will come down. So we must have adequate risk, adequate debt, right? So first solvency ratio is debt equity ratio. The formula for debt equity ratio is long-term debt divided by shareholders fund. Now in our problem, long-term debts are debentures, only one long-term debt, that is debentures, 2,50,000. And shareholders funds include equity share capital, preference share capital, reserves and surplus, minus fictitious asset. We don't have any fictitious asset, right? So we have equity share capital, preference share capital and reserves and surplus. So 5 lakh plus 2,50,000 plus 2,50,000, 10 lakh rupees are the shareholders fund. Now substitute. How much is the debentures? 2,50,000. So 2,50,000 divided by 10 lakh, 2.25. That means the debt is 25% of shareholders fund. The debt is 25% of shareholders fund. So according to norm, the debt can be up to 50%. The debt can be kept up to 50% of shareholders fund. Here we are having 25%. It's good. The business has good solvency position. The business can be able to go for a long period of time because the debts are below 50% of the shareholders fund. Next one, proprietary fund. The proprietary fund, the formula is net worth by total assets. Net worth by total assets. How much percentage of total assets are financed by shareholders fund? Financed by shareholders fund. So net worth means shareholders fund. The total shareholders fund 10 lakh rupees already we have calculated. Now total assets consist of fixed assets plus current assets that come to 14,50,000. Means total assets invested in the business is 14,50,000. Out of 14,50,000, 10 lakh rupees are the shareholders fund. 10 lakh rupees are the shareholders fund. So proprietary ratio comes to 0.69 or simply say we can say 0.7. So 70% of the total assets, 70% of the total assets are financed by shareholders fund. That's a good trend. That's a good trend. Next one is capital gearing ratio. Funds bearing fixed interest and fixed dividend divided by equity shareholders fund. So the formula is debentures plus other long-term loans plus preferential capital divided by equity share capital. The preferential capital should be taken in numerator. Denominator will take only equity, no preference. So for debentures are 2,50,000, no other long-term loan, preferential capital 2,50,000, equity shareholders fund, equity share capital and reserves and surplus. Equity share capital 5 lakh, reserves are 2,50,000. So 5 lakh divided by 7,50,000, 0.67. So capital gearing ratio is 0.67. That means 67%. 67% is of funds bearing fixed interest and fixed dividend. Next come fixed assets ratio. The fixed assets ratio formula fixed assets by capital employed. Capital employed means shareholders fund plus long-term debt. Shareholders fund plus long-term debt. Shareholders fund are 10 lakh and long-term debt is 2,50,000. So total capital employed 12,50,000. Fixed assets are 9,50,000 given in the problem. Tangible fixed assets, intangible fixed assets, total 9,50,000. So 0.76. That means the fixed assets are financed from total capital employed. It's a prudent policy that fixed asset ratio should always be below 1. Maximum 1. It should not exceed 1. That means the fixed assets must be financed only from capital employed, only from long-term funds. So here all the fixed assets are financed by long-term debt, long-term capital. Long-term capital. So standard ratio is 1 or below 1. It should never exceed 1. It is below 1.76. That's all. So we have calculated 3 liquidity ratios, that is current ratio, quick ratio, absolute liquid ratio, and 4 solvency ratios. What are the 4 solvency ratio? Debt equity ratio, proprietary ratio, capital gearing ratio, and fixed assets ratio. Now you have to give the conclusion. What conclusion you should give? Liquidity. The liquidity of the business is good because the current ratio is more than 2:1. The quick ratio is 1:1 up to standard, and absolute liquid ratio is more than 0.5. More than 0.5. So from these ratios, it can be concluded that the liquidity position of the company is good. The company is in a position to pay the liabilities on time, current liabilities on time. That's it. This is the interpretation. Now interpretation for long-term funds. The debt equity ratio is 0.25. That means the debt is 25% of shareholders' fund. That's good. Secondly, proprietary ratio. Proprietary ratio is 0.69. That means 70% of the total assets are financed by shareholders' fund. Capital gearing ratio is 0.67. So 67% of the funds are fixed interest and fixed dividend bearing fund. Then fixed asset ratio 0.76. It is below 1. So from this solvency ratio, we can conclude that the business has a good solvency position. The business can be able to go for a long period of time. The business has a good combination of debt and owner's fund, and all the fixed assets are financed from long-term funds. So from this ratio, we can say the liquidity and solvency position of the business is satisfactory, is good. That's it. Over. This is the 15th problem. 16th problem. Now I'm starting the 17th one. 17th problem is exactly similar to 16th one. The following balance sheets relate to Nagarjuna Company Limited. Share capital 4,50,000, reserves and surplus 50,000. Debentures 1,50,000, payable 70,000, bank overdraft 10,000. So two current liabilities, payables and bank overdraft. Long-term debt is the debentures, and fixed assets are tangible, intangible. Current assets are inventories, receivables, and cash equivalent. We don't have short-term investments. The company's sales during the year amounted to 4,50,000. You are required to assess the liquidity position of the company. Again, in this problem, it is not specified what ratios you have to apply. Simply, it is asking you to assess the liquidity position of the company. So you must know what are the ratios which indicates the liquidity of the business. Already in the previous 16th problem, I told you liquidity ratios are 3 ratios will apply: current ratio, quick ratio, absolute liquid ratio. But not only liquidity, at the same time we also calculate for solvency. For solvency, we apply debt equity ratio, proprietary ratio, capital gearing ratio, and fixed asset ratio. All these ratios again we calculate. So first of all, ratios for testing liquidity: current ratio, CA by CL. So current assets are inventories, receivables, cash and cash equivalent, add up 2,30,000. And current liabilities are payables and bank overdraft 80,000. So 2,30,000 current assets, 80,000 current liability. So divide 2.875 is to 1. 2.875 is to 1, it is more than 2. That means the current ratio is good because it is more than standard. The ideal current ratio is 2. So normally the current assets should be double. Yes, it is more than double. Good position. Then quick ratio. Quick assets by current liability. Now quick assets is equal to current asset minus stock minus prepaid. We don't have prepaid, but we have inventory. Inventory is stock. So 2,30,000 is the current asset you have calculated here. So 2,30,000 minus 25,000, 2,05,000. And current liability already we have calculated 80,000. 80,000 is the current liability. Now 2,05,000 divided by 80,000, 2.56. The standard quick ratio is 1:1. But we are having 2.56. It's good. It is above standard. So current ratio and quick ratio indicates that the liquidity position is good. Now absolute liquid ratio. So absolute liquid assets by current liability. Absolute liquid assets, just now I told you, short-term investments plus cash and cash equivalent. Short-term investment plus cash and cash equivalent. But short-term investment we don't have. Only cash and cash equivalent we have 80,000. So absolute liquid assets are 80,000. Whereas current liability is 80,000. So 80,000 by 80,000, 1:1. The standard absolute liquid ratio is 0.5. 0.5:1 is the standard, but we are having 1:1. It's good. So all the three liquidity ratio indicates that the liquidity position of the business is satisfactory. Nothing to worry. The company is in a position to pay the current obligations on time. That is the conclusion. Now we'll calculate the solvency. Ratios for solvency: debt equity ratio, long-term debt divided by shareholders fund. Long-term debt means debentures. Debentures are given 1,50,000 in the balance sheet. And shareholders fund, equity share capital plus preference share capital plus reserves and surplus. So equity share capital is given 4,50,000. No preference share capital. Preference share capital is not given. So reserves and surplus are 50,000. So equity share capital plus reserves and surplus, 5 lakh rupees is the shareholders fund. Now we apply debt equity ratio, 1,50,000 is the debt and 5 lakh rupees is the shareholders fund. So 0.3. That means 30% of the total fund is debt fund. Debt fund. For every 100 rupees invested in owner's fund, 30 rupees is debt. That means the debt is 30% of owner's fund. That is good. Approximately up to 50% also it's good. The debt equity ratio, normal debt equity ratio is 0.5. It is less than 0.5. It's a good trend. It should not be more than 0.5. Next is proprietary ratio, net worth by total assets. How much of assets are financed by shareholders fund? How much of total assets are financed by shareholders fund? So here net worth means shareholders fund 5 lakh and total assets, fixed assets plus current assets 7,30,000. 7,30,000 of the total assets invested. Out of total assets invested, how much is the shareholders fund? 5 lakh. So what is the ratio? 5 lakh by 7,30,000, 0.68. And 68% of the total assets are financed by shareholders fund. It's good. Next one, capital gearing ratio. Funds bearing fixed interest plus fixed dividend divided by equity shareholders fund. Debentures plus other long-term loans plus preference share capital divided by equity shareholders fund. So here debentures we have 1,50,000, no preference share capital, no other bank, no other loans. Equity shareholders fund are 5 lakh rupees, already we have calculated. So again 0.3. Capital gearing ratio is also 0.3. Debt equity ratio and capital gearing ratio are equal because there is no preference share capital. Next one is fixed assets ratio. Fixed assets by capital employed. Fixed assets are tangible, intangible, 5 lakh. Then capital employed. Capital employed means shareholders fund plus debentures. Shareholders fund plus debentures is equal to capital employed. So shareholders fund 5 lakh, debentures are 1,50,000. 6,50,000 are the capital employed. So here fixed assets ratio 5 lakh by 6,50,000, 0.77. I told you that it's a prudent business policy that the fixed assets must be financed from capital employed, from long-term funds. Capital employed means long-term funds which include owner fund and debt fund. Long-term fund. That means all the fixed asset must be financed from long-term funds. That means the ratio should be 1 or less than 1. It should never be more than 1. The fixed asset ratio should be less than 1, but it should never be more, maximum 1. So here it is 0.77, good. So from these ratios, ultimate interpretation you should write. The above ratio shows that the liquidity position and the solvency position of the company is satisfactory. Since all the ratios are above the standard, there's a proper combination of owner's fund and debt fund. So these are the conclusions. I have explained you about the interpretation because in examination this type of problem you have to write interpretation. In earlier problem it's optional, but here it is compulsory. This type of problem you should give the interpretation. That's it. So I have applied full effort in explaining each and every point. Whatever knowledge I have explained you in detail. So if you are satisfied with my lecture, give a like to the video. Share my channel in your group, in your friend circle, so that more students can watch the video and increase their knowledge. Give your comments on these videos. And lastly, don't forget to subscribe my channel if you have not yet subscribed. We'll continue the next problem in the next video.